My name is Jordan Vinci. I am the Executive Director of the VIN Foundation, and we tonight are doing the Part 2 webinar of Veterinary Student Debt Questions and Answers with VIN Foundation board members Tony Bartels and Carl Darby. We are very lucky to have both of them with us. So if you guys want to say hi, we're just getting started here, and we're also live on Facebook.
Hi, guys.
Hello. Yeah, well, I see that people are still rolling in, so we'll maybe give them a couple more minutes to get in here and get settled, and we'll get started.
Okay, we are now live on Facebook as well.
Very cool. Well, I still show we've got a minute before we were due to start, so we'll give the last minute stragglers all the time in the world. I should snooze this stuff. Okay, well, I think we'll go ahead and get started. So welcome everybody to part 2 of veterinary student debt. Started out with some questions and answers. So we're going to continue on based on the presentation that Carl and I did a couple months back, in addressing some of the questions that come up frequently across social media platforms, at conferences, on VIN, in our email boxes. So we wanted to address some of those common questions and concerns that we hear most frequently, and we decided to add a second part to this, where we're going to dive a little bit more into case specifics. Right, so this is going to be part 2, where we're not going to spend a lot of time on the nuts and bolts of student loans and repayment options. I'm going to kind of roll into a few different cases that come up quite frequently and use the tools that are freely available to you all on the VIN Foundation Student Debt Center to show you how those different scenarios behave in income-driven repayment and how you can compare that against some of the other options that are out there. So before I dive into that, I'm going to open the floor up to Carl, see if he has anything to add.
No, I'd just like to thank everybody for attending, and huge thanks to Jordan and Tony for their time and Tony's expertise. We got a lot of positive feedback from the last webinar, and hopefully we can dig a little deeper this time and answer more specific questions. If there is a question, do feel free to post it on the page here in the question and answer section, and we will be having some little breaks where Tony will be able to address those questions. So without further ado, let's get started. How are you, Tony?
All right, so we will dive into the part 2 here. And just to kind of set the stage and do a really brief overview, some of the confusion that happens most frequently when it comes to student loans is considering income-driven repayment versus what I consider traditional repayment options. So those things that fall into the standard, extended, graduated, and I'll even lump private refinance into that conversation because that's basically the same as a standard or extended repayment plan. But the gist of the traditional repayment options are that the payment is determined based on your principal, the interest rate, and the length of time that you're committed to pay back that student loan. So it really doesn't care whether or not you have the financial means to make that payment. It's strictly a mathematical calculation in terms of your principal, your interest rate, and the length of time to repay. Unlike the income-driven repayment plans, as the name implies, you can pay based on your income, and the minimum monthly payment is determined as a percentage of your income. And one of the common questions that pops up for me quite frequently from veterinary students and veterinarians in repayment is there a magic number I should pay on my student loans each month, right? So you have the minimum that's determined either through your income, or if you're using a traditional repayment plan, you have that minimum monthly payment. But oftentimes people are wanting to either pay more or not sure if that's the magic number that they should be paying. And what I use really is the concept of income-driven repayment, I think, answers that question wonderfully, right? So there's not necessarily a magic number, but there is a magic percentage. And while we're getting started, I would encourage all of you who are attending to just follow along in this quick calculation. Do the math to see what your payment would be under income-driven repayment and see if it's more or less than what you're paying now, right? Because that's really what we want to focus on. So income-driven repayment, again, as the name implies, is a percentage of your discretionary income. So depending on your discretionary income and then the plan that you choose to use, it will either be 10 or 15% of that discretionary income. So your discretionary income is your taxable income less 150% of the federal poverty guidelines. And you can look up those federal poverty guidelines. The link is there for you. It's based on your family size and a measure that's loosely tied to inflation. It gets updated every year around January, but you can pull that number. We can go through an example here just to get you started. So if you had a $90,000 taxable income and a family size of 1, we would take your $90,000 and we would subtract off 1.5 times $12,490. This $12,490 is the federal poverty guideline for a family size of 1 in the lower 48 states, right? So that's kind of what the government allows you for essential living expenses, if you will. So they'll subtract that amount off, and the remainder is your discretionary income. And we're going to apply one of those income-driven repayment plan percentages to that discretionary income to come up with a monthly payment. So if you're using pay-as-you-earn or revised pay-as-you-earn, your monthly payment would be about $600 a month. With a $90,000 taxable income and family size of 1. If you're using the older version of IBR, it would be $891 a month. So for you right now, the question is what I just walked through, is that payment amount based on your income less than what you're currently paying? If that's the case, then you really want to consider income-driven repayment. If you're using income-driven repayment, you want to make sure that they're actually calculating the payment correctly. So this is a good time to try to see if your loan servicer is doing you right, because we see them make mistakes all of the time. And if your payment is actually less than that now, and you're using something like an extended or a graduated repayment plan, then you may consider looking at income-driven repayment to see what that might do to your long-term repayment cost. So in order to figure this out, and we're going to break this down first into the immediate, right? So how do I know what my payment should be, or what plans I even qualify to use? And that's where we're going to go through the VIN Foundation My Student Loans tool. So I'm going to encourage you to visit the National Student Loan Data System, and I'm going to go to that now. So let me take you over to that really quickly. So that's nslds.ed.gov. And this is the official repository of your federal student borrowing history. Right? So what you're looking for here is this financial aid review link, right? Or you can even click on this My Student Data download. That's ultimately where we want you to go. You're going to need your FSA ID credentials to get in here. So the same username and password that you use to apply for federal student loans. If it's been a while since you've been in here, or since you've applied for federal student loans, your old PIN number, your old FAFSA PIN, you can convert that into an FSA ID. So you may need to do that first before you can get in here, and that might take a day or two before they'll allow you access. But once you gain access, you're going to want to click on that financial aid review link. It'll ask you to log in with your FSA ID credentials. Oh, it wants me to change my password. I'm not going to do that right now. So you're going to have to get in there and see what that looks like. But you're basically looking for, I'll show you this. When you get in there, you're looking for this My Student Data download button. So it'll look like this. You'll see a summary table when you get in there. You can click that once you're logged in, and it'll actually pull down your NSLDS file. What you can do with that afterwards is go to the VIN Foundation Student Debt Center and upload that NSLDS file into the My Student Loans tool. So you're going to come here, click on the My Student Loans tool, and we're going to upload one to sample. So I'm going to assume you're graduated for the purpose of this upload, and we're going to go into, this is a good sample file that I have that illustrates some various student loans that you might have acquired during the course of getting to and through veterinary school. It'll generate a summary of information, and what we want to focus on here is first this summary. We know we've got 17 loans. We can see that we've got $374,000 of principal. This person graduated in 2012, and they've been using income-driven repayment, so they have quite a balance of unpaid interest, which is not uncommon. We'll talk about that in a little bit. Total owed is a little over $500,000. We have a weighted average interest rate, which is important for understanding how to handle this, because as we can see, there's a whole bunch of student loans in here with a bunch of different interest rates. It can be really difficult to make sense out of all that. So we help with you with this weighted average interest rate. Gives you an idea of how much interest is accruing each month, as well as the monthly payment, right? So we know that they're using IBR. Their minimum monthly payment based on their income right now is $264 per month, which is much less than the interest that accrues, which is how you can end up with an unpaid interest balance of $132,000. If you're doing that for 6 or 7 years, you're going to end up with quite a bit of unpaid interest. The other piece that I want you to focus on in here is this income-driven repayment eligibility tab. So depending on when you started borrowing, the types of loans you have, that's going to determine what plans you're eligible to use. We can see here that this particular person, all of their balance qualifies for IBR, which is the plan that they're using. They do not meet the new borrower requirement for pay-as-you-earn, so none of the loans qualify for pay-as-you-earn. They could use revised pay-as-you-earn for the direct loan portion, right? But that's 73% of their total portfolio. So if we go back here and look, we can see that they have both direct loans and these older school FFEL loans. These are loans that existed prior to July 1st, 2010. Right, so you may see some of those if you were borrowing around that time. They're the only income-driven plan you can use with those FFEL loans are IBR, so the old version of income-based repayment. Or you can consolidate them into a direct consolidation loan. But since this person's already been in repayment for 6 or 7 years, consolidating them would restart the forgiveness clock, and that would not be worth it, right? So, and this person is also filing their taxes separately, which IBR allows you to do. Revised pay-as-you-earn doesn't allow you to do. We'll talk about that more when we get to the married cases. But there's a specific reason this person is using IBR. One of them has to do with they already had gotten started in repayment. They have a significant balance that doesn't qualify for revised pay-as-you-earn or pay-as-you-earn, and because their family specifics dictate that they should file their taxes separately, they're going to use IBR because it provides that flexibility to do so, to keep that monthly payment where it is now. So we're going to come back to the presentation. So that's this part right here, right? So if you can get into that NSLDS system and download your file and upload it into the My Student Loans, you're already going to be a little bit ahead of the ball game here. And then the next parts, we're going to dive into what to do with that information, right? So we can give you that snapshot of the plans that you qualify for now. We can do this math to figure out what our monthly payment should be right now or this year, but then we want to look at that into the future, because projecting the simulation out into the future is ultimately going to help us compare income-driven repayment against some of the more traditional repayment options. So let's dive into the high student debt scenarios. So which plan should you use? How much do I pay? And how do I plan for forgiveness? But first, what is high, right? What is a high student debt scenario? So we can turn to some of the data that's available. This is recently published information from the AAVMC, Association of American Veterinary Medical Colleges, and this is for 2018 graduates. So this is the minimum and maximum reported debt for graduates of that 2018 class for the schools that are represented there. And we can see that somebody from Michigan State reported $440,000 of student debt. That was the max for them. Sometimes the median is a little bit more informative, right? So, of course, there's going to be a few people that are going to have high student debt or low student debt on the extremes, but we can look at the median and see, well, what is a good representative sample of high student debt? And Midwestern 2018 is the first graduating class for those folks over at Midwestern, the new veterinary school in Arizona. And we can see that the median reported indebtedness for those 2018 graduates with student debt was $329,000, right? And then we can keep going down the line here. We've got Western is a little bit behind there, St. George's, Lincoln Memorial, another school that came online recently with their first graduating class in 2018. So we can see there's a significant number of schools here that have a median reported debt with a value of $300,000 or more, right? So that gives you an idea of just generally what high might be. We can't really talk about debt without talking about income as well, right? So the student debt to income ratio. So it's the income that really makes it difficult to pay back student loans traditionally, and the reason why we have to lean on income-driven repayment. And what we see here, and this is from the 2017 graduating class, most folks, so 77% or so, graduate with debt that exceeds their income, right? So that is a scenario, so debt to income ratio greater than 1, that favors income-driven repayment. And when we get into debt to income ratios greater than 2, usually you're going to see income-driven repayment come out on top financially, right? And we're going to show that with a simulation. So debt to income ratio greater than 2, I'm going to call that high debt, right? So student debt to income ratio greater than 2, that's where you're going to want to focus heavily on using pay-as-you-earn, revised pay-as-you-earn, income-based repayment. You're going to want to pay the minimum as determined by your income and family size and plan for that forgiveness. And we'll illustrate that in just a little bit here. We do have this scenario where, you might fall into a gray zone, right? So if your debt to income ratio is greater than 1 but less than 2, income driven repayment is going to be beneficial for you, but it's going to depend specifically on the specifics of your family situation and whether or not you think your income will increase or decrease in the near and long term. If your debt to income ratio is a little less than 1, that's what I'm going to consider a low debt scenario, right? And we're going to cover low debt after we do a high debt case. But low debt is those debt to income ratio less than 1. That is what traditional repayment was built for. So making payments that are generally 10% or less of your income, but you're still going to pay that student debt balance down in a reasonable amount of time, often 10 years or less, right? So that's what traditional repayment is really good at. You can still use income-driven repayment or even use some of the income-driven repayment plans like revised pay-as-you-earn as a gauge for helping you determine how much you should pay, maybe tying your payment to 10% of your income, even if it's the minimum is a little bit less than that, and we'll show you that. But the key there is you really have a lot of flexibility and options. You can use traditional repayment, you can use a private loan refinance, you can use income-driven repayment, if nothing else, as a guide to help you understand what you should pay towards your student loans. But I will tell you that I get a lot of questions, and probably some of the most stressed out folks are the ones who are carrying that debt to income ratio less than 1. And I get it, right? That having any kind of debt can sometimes feel like it's a really big deal. But if you're in that debt to income ratio less than 1, you're going to be fine, right? You will pay your student loans off in a reasonable amount of time using a reasonable percentage of your income. It's just up to you to figure out, what's going to help you get there, either as fast as possible or as cheaply as possible, while still focusing on your other financial plans, right? But it's when you get above 1 that it becomes a little bit more delicate, and we lose some of that flexibility, and we really have to rely on some of those income-driven repayment options and all the side effects that come with them. So just as a comparison, right, we're going to kind of set the stage for our high debt scenario here. So let's say you had a federal student loan balance of about $300,000, as I showed you is not uncommon in veterinary medicine at 6%. Let's say you have an income of $100,000. I'm seeing that pretty frequently too from recent graduates, particularly in small animal and in urban areas, in a family size of 1. So we can start to look at what, if you just do this on a traditional repayment plan, a standard 10-year, which is the default repayment plan for federal student loans, you're paying $3,300 a month to pay that off at a cost that's just under $400,000. Now we can extend that to 20 years or 25 or even 30, and our payments will go down because we're taking a longer time to pay it, but we're also paying much more, right? So you extended 30 or extended 25, $647,000 or $580,000. That's a lot compared to what you borrowed. And generally speaking, these income-driven repayment plans are going to have you paying less, right? So even when $100,000 income or taxable income, you're going to be paying $670, $680 per month. The total cost, we have to put a question mark here because we don't know. We don't know if your income is going to go up, and if it does go up, how high is it going to get? Are you going to get married? Will your spouse's income contribute to that? Will you have kids? Will your income go down when you have kids, right? So all of that's going to affect this projection of the cost, and that's where we turn to the student loan repayment simulator. And what we see is when your debt to income ratio is greater than 2, and in this case we're at 3, right? So student debt 300,000, income 100,000, that's a debt to income ratio of 3. We're going to see the total repayment cost come in even under a standard 10-year amount, right? So that's why these plans are so beneficial when we have these high debt scenarios. But you're going to want to look at this percentage of your take-home pay, right? So $3,300 a month after taxes is not going to leave you with a whole lot left, right? So there's really no reason to beat yourself up like that when you can pay a lot less, but repayment's going to look a lot different, right? Especially if you anticipate maybe having some kids in the future, taking some unpaid maternity leave, maybe your income is going to go down before it goes up again. That's where, again, income-driven repayment is really going to help you. And it also allows you to have other financial goals, right? So not postponing retirement savings. You can build an emergency fund, you can buy a home, you can think about buying a practice, starting that family, right, without trying to punish yourself for that first 10 years, trying to pay your balance back as fast as possible. So let's go back over to the VIN Foundation Student Debt Center, and I'm going to upload another case here.
Tony, before you do that, can we just, someone posted a question about with high debt scenarios, what do you expect to have higher income trajectory down the line? For example, owning a clinic.
Yeah, I think that, it really depends on what you expect that higher income to be, right? I'm still going to use my debt to income ratio as a guide in that scenario. And if you end up taking on practice ownership and you have a really successful practice, which I hope you do, right, then you still want to wait until your income dictates that you pay more towards your student loans, right? So as your income goes up as a practice owner, your monthly payment towards your student loans will go up. It just depends on where you are in the repayment time frame, right? So when do you take on practice ownership? When do you expect that jump in income? And then how much longer do you have towards forgiveness? And then you see if you're still going to hit forgiveness or not, but you still let your income determine that particular situation. So, I mean, if you have a high student debt, let's say you have $300,000 of student debt, you're really not going to think about changing your student loan repayment trajectory until your income well exceeds that $300,000. And maybe that could very well be possible as a practice owner, but wait until you get there, right? Worry about that when you get to that point, and congratulations, right, when you reach that. But it still may not mean that you end up paying back your student loans to zero before you reach forgiveness. It's going to depend on where you are in the repayment time frame and how much time you have left before you reach forgiveness, right? So you really just let your income determine that situation.
Yeah, sure, and exactly. And as a practice owner, the other thing I think to mention is, if you're making decent income as a practice owner, you may want to look at paying off the practice loan because that's a much less flexible loan than the student loan. So if you have extra income, it may be to your advantage to use that towards the business loan rather than your student debt.
Right, absolutely. I mean, there's a whole bunch of other things that you could probably do with your money that is more beneficial than paying back your student loans, right? So if you were able to buy the practice and now you have a successful practice, those student loans are preventing you from doing anything like buying another practice, right? Or investing your money in other endeavors, right? So don't get sidetracked by thinking you have to pay your student loans back faster than your income allows. So this is a high debt scenario case. This is a recent graduate, 2017 graduate, has a $369,000 principal balance, no unpaid interest, and that's because they are using an extended repayment plan, right? So, and this is something that I see quite frequently too, is that there's a lot of mistakes made early on in the repayment process. And I think a lot of it has to do with just not understanding your repayment options, right? I mean, income-driven repayment, particularly as you're just getting started, is going to be your lifeline, right? So even if your debt-to-income ratio is near 1, you could still use income-driven repayment just as you're getting started. These extended plans, so you're guaranteed to pay your loans to zero with an extended plan, which is why there's no unpaid interest. You're not allowed to have unpaid interest in an extended repayment plan. Your monthly payment covers the interest plus a little bit of the principal. Right, so your monthly payment cannot be less than the monthly interest, but that's a hefty monthly payment, right? So this person I know is doing well, right? So they have one of those incomes that is above the average, small animal, urban environment, but still income-driven repayment may be a better way to pay back their student loans and give you a little bit of cash flow flexibility. So next step is to look at the income-driven repayment eligibility, right? And we see that this person qualifies for all of the beneficial plans except for the new version of IBR, which is really not that beneficial. It's about the same as pay-as-you-earn, the new version of IBR, but pay-as-you-earn is actually better. So even if you do qualify for the new version of IBR, you're going to want to use pay-as-you-earn anyway, right? So this person has all of these options available to them. So we'll send it over to the simulator and see what the best repayment option should be. So we don't have any unpaid interest, average interest rate. I want to go back here too really quick. So one of the things that I can often see too in your files is whether or not you're using the auto pay feature. So this person is, right, because I know what the interest rates are on these student loans when they were taken out, and I know that they're 0.25% lower than they would be if they weren't using auto pay, if that makes sense. So take advantage of that auto pay. If that means that the loan servicer is going to automatically deduct your minimum monthly payment per month, right, at the minimum level, but they'll give you a 0.25% interest rate discount for doing so. And that may not seem like a lot, but when we're talking about $369,000 over 25 years, right, or 20 years, that those savings will add up. So take advantage of that auto pay feature, which this person is doing. So they are using an extended plan, and they've been doing so for about 2 years. Their income, and in this particular case, I know this person's income is $90,000, right? And then this is where we get into a little bit of the, how do we want to project this person's income, right? So you're going to know your income situation best. Do you think that you have the ability to earn more at your practice? Are you seeing a higher caseload? Are you starting to see cases that allow you to earn a higher income, right? All of that is going to determine how much your income is going to increase or decrease over time. What we tend to see from the AVMA economic data, if we average it out for an associate over a long period of time, it tends to be about a 3.5% increase per year, but it usually doesn't happen on a straight line, right? So usually your income increases in the first couple of years steeply, and then it levels off, and then it starts to maybe even decrease if you don't take on practice ownership or find a way to specialize in another skill that allows you to earn more income. This particular person is not currently married, but you can factor in marriage into the future, as well as children if you have them now or even in the future. And then we have some simulator settings here in the advanced section for if you anticipate hitting forgiveness, what do we think that tax rate is going to be? as well as the poverty growth rate, which is how we adjust the poverty guidelines that factor into the discretionary income calculation. So we'll run this simulation and we'll see what this shows us. Right. So, and we know that this person is currently making a payment that's closer to $2,500 a month, or somewhere along the lines of that standard 25-year payment. We know that if they move over to pay-as-you-earn, and we know that they qualify for pay-as-you-earn, their payment will be a little less than $600 per month in that first year. There's 20 years until you reach forgiveness under pay-as-you-earn. Right, so if you keep making the minimum payments based on your income and you have a balance remaining at the end of those 20 years, it will be forgiven and treated as taxable income, which is what we see here. Right, so we end up having $609,000 forgiven. If we assume a 30% tax rate on that, you'll end up having to owe the IRS about $183,000 20 years from now, for a total cost of about $391,000. Right, which is markedly lower, $100,000 less than trying to pay your loans off under a standard 10-year, and almost half as much as if you continued on in that 25-year extended plan. Right, so there's a lot of money on the table here to be had if you figure income-driven repayment and project it long-term. Now, the challenge arises, particularly in the high debt scenarios and with pay-as-you-earn, is how am I going to cover that tax? Right, so if I have $609,000 and I'm assuming a 30% tax rate, I need to figure out how I'm going to come up with $183,000 20 years from now. You can do that by saving $555 and earning a 3% return on those savings for the next 20 years, and you'll decrease your repayment costs even further, right? Because you're using that power of compound interest to help you save for that tax that's due, and you end up reducing your total loan repayment costs, and now you end up paying, actually in this case, less than what you currently have remaining, right? Which is not uncommon in the high debt scenarios, right? Because you end up pushing so much of the balance into forgiveness, and we're paying a taxable fraction of what's remaining, that you often see you paying a little bit less than what you have remaining, particularly in those high debt scenarios, right? So if you're not comfortable with, maybe you think the tax rate is going to be higher, right? You're going to have to add this to your monthly payment, right? But it's not going towards your loan servicer, right? So you're paying $600 to the loan servicer. You're going to stash this away in a separate account, so $650. So your total monthly student loan burden is about $1,250 per month, which is still much less than what you're currently paying, and way less than if you try to pay it off faster, right? So you still have more than $1,000, $1,200, $1,300 in this case to work with each month to put towards other financial savings goals, like buying a home or working towards that practice ownership scenario, starting a family, those types of things, right? So it's like giving yourself a raise without even having to see another client, right? So just by changing the way that you pay back your student loans, and you're going to pay less doing it, right? Markedly less in those high debt scenarios, right? So in this case, I would highly encourage this person to get out of that extended plan, get into the most beneficial income-driven plan they have, which is pay-as-you-earn here, pay the minimum, and start planning for the forgiveness. I'll stop it there and see if there's any additional questions on the high debt scenario before we move on to the low debt.
Yeah, Michael asked if the graphs with the graduate student debt included undergraduate debt.
If it included undergraduate debt, we can go back and look and see. So this person I know graduated in 2017. So if we go back and look at when they started borrowing, so they would have started vet school around 2013. So they definitely had undergraduate debt here. And go ahead.
Sorry. Are there any resources to guesstimate how much tax interest work will be by the time we need to pay for the forgiveness tax bomb? Yeah, that's a good one.
Yeah. So we're in tax filing season now, right? So I would encourage you to look up and see what the top marginal tax rate is currently for the federal income taxes. It's 37%, and that starts for a single person at income above $300,000. And when you're married, it's above 600,000. And those brackets get adjusted by inflation, right? So chances are that if we don't radically change how we tax folks in the next 20 or 25 years, those tax rates are largely going to be the same as they are now. It's just that the brackets will get adjusted by inflation, which means that the amount that's forgiven is probably going to fall in a lower tax bracket than it would today, right? So that's why we default the tax estimation to 30% in the simulator. I think that's probably a conservative estimate. But if you live in a high tax state as well, because you're probably going to have to pay state income taxes on this as well. If your state has income taxes, you may want to bump that up a little bit, depending on how much you're projected to have forgiven 20 or 25 years from now.
Yeah, and people are asking about, the confidence in the forgiveness plans. And, these are government plans. I think we can assume that they're pretty safe. And if there are changes, generally speaking, those have been, to new loans, they haven't included, they've not been backdated to previous plans or things like that. So, I think it's a pretty safe, option.
Yeah, I would also encourage folks to read their master promissory note, right? So if you either whether you consolidated your loans or when you took out your federal direct loans, all of these things are laid out in that contract, and it is a contract, right? So you have a contract with the federal government to pay back your student loans, and in that contract, they lay out all of these repayment options. And what we've seen, right, and one of the reasons why we have two versions of IBR, pay-as-you-earn, revised pay-as-you-earn, is because we keep adding new plans, right? We haven't taken any away. There's still an old one on the books called, there's two actually, income sensitive repayment and income contingent repayment. They're just not very useful anymore because we've added new plans that are much more beneficial. So those folks, if they're still using them, would probably benefit from switching into one of the newer plans, depending on the specifics of their circumstances. And all of the proposals that have been made to date all talk about adding another set of repayment options and a different type of student loan that wouldn't have these types of repayment options. But those are for folks who haven't started borrowing yet, right? Because there's 44 million loan borrowers out there, and they all have contracts that have all of these details laid out, which is why nobody's proposing to take these options away from existing borrowers. They're talking about creating a whole new loan system with a whole new set of repayment options that would be for borrowers in the future. Right, so read the rules carefully. Right, there are no proposals. Even in the 2020 White House budget proposal, they propose eliminating some of these plans, and they also propose eliminating public service loan forgiveness. But it's for folks in the future, right? Not you, not the folks who have already started borrowing, and not the folks who are already in repayment. So be really, really careful when you read stories about eliminating income-driven repayment options.
And the final question is really beyond the scope.
Oh, we heard, I think Carl's internet might have dumped him there.
Scope of what we're discussing tonight, but some people are asking. So people are asking about, the different plans. How do you save money? Do you use Roth IRA? And I think at this point, hopefully in the future, maybe we'll have something, maybe we'll do a webinar on that. But I think for now, a good financial advisor can help you determine the best way to invest money, and it's just investing money. It's regardless of what the cause is, the underlying fund is for. It's just about how do I invest my money, and a good financial advisor could help you steer you towards the right product. But maybe we'll do something to address that.
Yeah, I'll just a couple minutes on that. So the first rule is just get started, right? I mean, so you can get 3% pretty easily these days, right? Again, which is why we default this value to 3% in the simulator. You can go to bankrate.com or nerdwallet.com and look at all of the different online savings vehicles that you could get 3% with little to no effort, with almost no risk, right? So CDs are earning a little over 3% right now. Online savings accounts are earning 2.25% right now, right? So there's things that you can do just to get started and start building up that forgiveness plan And then once you have a little bit of money in there, you can start to think about maybe being a little more aggressive with that. And that's where I would turn to like a certified financial planner. Take this target, right? I need to have $213,000 20 years from now, and I'm saving $650 a month. Help me craft a portfolio to get there, right? That's what they can help you with, right? But just get started. I mean, just don't let the myriad of options paralyze you from getting started. I would caution against using retirement accounts for your forgiveness fund, right? Use retirement accounts for what they were designed for, which is your retirement, right? So have a separate taxable account that you're going to use to plan for forgiveness, because you don't want to be borrowing from your future self in order to cover your forgiveness fund. So, and there's a lot of rules that don't favor this. The average veterinarian graduates school in their late 20s, right? And there's penalties for taking money out of Roth IRAs and traditional IRAs and 401ks before 55 and a half. And you're probably going to end up hitting forgiveness sooner than that, right? So again, forgiveness planning and retirement funds do not go hand in hand, right? So the concepts do, right? So long-term investing is that those concepts are similar, but don't use those retirement-specific accounts for your forgiveness planning fund.
Okay, I think that's it for now. Let's move on.
All right, cool. So low debt. So I didn't borrow that much. I don't think I need income-driven repayment. How do I know when I should pay more, and how much more do I pay? And should I, or when do I refinance if you think that that's an option for you? So kind of like we started with last time, let's define what is low. So let's go back to our debt to income ratio graph here, right? So again, what I consider low is a debt to income ratio of 1-to-1 or less. And we can see that that's the minority of folks, right? So at least when we look at new graduates, that's a really small percentage of folks who complete veterinary school with a low debt to income ratio, particularly a debt to income ratio less than 1. However, if you're in that a little bit higher than 1, so maybe you're at 1.2, 1.4, and your income, as we discussed a little bit earlier, maybe your income is going to increase quickly in those first few years after graduation, and you see yourself earning more than what your debt balance is within first 3 to 5 years after graduation, right? I would consider that to be a low debt to income situation as well. So what should you do, and how should you plan? I do think the timing is really important here, as it always is with income-driven repayment, because there's a clock involved, right? So income-driven repayment, you pay based on your income for a certain amount of time, and if you don't pay your balance to zero before you reach that defined time period, like 20 years and pay as you earn, then you will have the remainder forgiven, right? But when your debt to income ratio is near 1-to-1 or is even less than that, the likelihood of you having anything forgiven is quite low, right? So you're going to hit loan balance zero before you reach forgiveness. So you can choose to do that under a income-driven plan if you want to, particularly as you're getting started, or you can use the standard 10-year repayment plan. That's really what that was designed for, right? So the standard 10-year plan, back in the golden days when you could graduate with debt that didn't exceed your income from college, you could pay back that student loan using 10% or less of your income in 10 years or less, using that standard 10-year plan, right? That situation doesn't exist for many people anymore, right? But that's when it can work. That standard 10 years when your debt is less than or equal to your income. Repay, I really like, because it uses this concept of pegging your monthly student loan payment to your income, right? It's 10% of your discretionary income. Whether you use repay or not is up to you, right? But you can still use the student loan repayment simulator, look at what your payment would be under repay, and it'll tell you, well, this is 10% of your income. So if you pay 10% of your discretionary income towards your student loan balance, sometimes you'll see you pay your loan balance off even sooner than 10 years. And that's what we're going to show in the low debt case. And this is where private refinance can also work. So again, private refinance, very similar to a traditional repayment. Sometimes you can get a lower interest rate depending on the specifics of your application and your credit history and whether or not you're willing to bring a cosigner. But private loan refinance, just be cautious that once you refinance your federal student loans with a private loan, you can't go back, right? So I tell people that, I really wouldn't consider a private refinance until my debt is less than my income, and I anticipate that that situation is going to persist for the duration of repayment. I don't want to have any unexpected decreases in my income and then be left with a payment that I can't adjust, right? And that's really the risk of the private loan refinance and the standard plans, is that you can't adjust your payment if your income should decrease, right? And I don't want anybody's income to decrease, but life sometimes has a funny way of getting in the way of those plans. So I want to leave myself the most flexibility I can, which often has me sticking with the federal student loan repayment options, which also include income-driven repayment in case I need it. So let's go back over to the student loan, VIN Foundation, My Student Loans. I'm going to upload a lower debt scenario to this My Student Loans tool. All right, so here we see somebody that graduated a few years back, so 5 years ago at this point, has a current principal balance of roughly 83,000 at a weighted average interest rate of 6.1%. So I'm going to do my general physical exam here. I'm going to look and see if they have some other student loans. Looks like they had some FFEL loans that are paid off already. I can look at the interest rates and I see some funny numbers here that don't look familiar, so I know that they're using the auto pay deduction, which is great. They're on the extended repayment plan, which is most likely a standard 25-year plan. It can be 15, 20, 25, even 30, but chances are this is a 25 or 30-year repayment plan. They're accruing $422 a month of interest, and their monthly payment exceeds that. So we know that they're working their way towards student loan balance zero here. And they will hit zero, and whether it's 20 years or 25 years, depending on the maximum term that they chose. If I come over here, I see that this particular person does not qualify for pay-as-you-earn, right? So they don't meet the new borrower threshold for pay-as-you-earn, which means that basically you couldn't have had a loan with a balance prior to October 1st, 2007. So we can go back over here and confirm that and see, yes, I can actually sort this. Come down here. What happened is this loan, right? They missed it by like 2 months being eligible for pay-as-you-earn. This loan probably got consolidated into a direct consolidation loan, and you can't consolidate your way into pay-as-you-earn. You either qualify or you don't. So they don't qualify for pay-as-you-earn, but that's okay, right? So they already have a pretty reasonable minimum monthly payment. That's $634 per month, but we can send this over to the simulator. And this is where we'll put in a income that exceeds that, right? So we'll put, maybe a $90,000 or $100,000 income in here. We're going to say that they've been on an extended plan for 5 years. One other thing I want to note that I think I forgot to note from the last one, if you're that person that was using the extended plan, the time that you spend in this plan doesn't count towards forgiveness, right? So if you switch to an income-driven plan from an extended plan, that time doesn't count towards forgiveness, which is one of those reasons why I want folks to get started in income-driven repayment as soon as they can after graduation, to get that clock ticking and get that time logged towards forgiveness if you ultimately end up hitting it. So in this scenario, let's use an $85,000 income, right? So their debt is just below their income. I'll decrease this percentage, right? They've been out for 5 years, right? So maybe they've accelerated their earnings in that first few years, and now it's starting to trail off a little bit, right? And we'll leave the family situation out until we get to the married section next, just to see what happens if we compare this against the standard plan, right? So what we see is, and this is where when I see a debt to income ratio that's near 1 or less than 1, I'm immediately going to revise pay-as-you-earn, because I want to look at what does the increase in my income, what does that payment right now compared to what I'm paying now, and we know that she's paying about $600 and something per month now, it would actually be a little bit less under revised pay-as-you-earn. But that's okay. She can still stick with the plan that she's in. But we see that if she were to actually pay based on her income using the revised pay-as-you-earn, she would pay her balance off faster, right? So she's got about 20 years remaining left in her plan. She would have 16 years under revised pay-as-you-earn and would hit loan balance zero. So what might that look like? So if I go down here to this graph, I can see that this gives me an idea of how much I should pay each year as my income increases, right? So it'll be a little bit more than you're paying now, right? But as you pay more, if you're projected to hit loan balance zero, you will actually end up saving yourself some money, right? But you want to keep it as a reasonable percentage of your income. And in this case, I think 10% of your income is actually a really good metric to use to target how much I should pay towards my student loan. So as my income increases, that standard extended repayment won't increase. It'll stay the same. And you can continue to keep paying that and it'll pay your balance to zero. But if you peg your payment to 10% of your income, right, you can pay the balance off sooner, in this case 16 years from now, as opposed to another 20 years from now, and you'll save yourself some money, right? So you can use repay, right? You don't have to actually switch to repay unless you really want to, right? But you can use repay and then track the estimate based on your discretionary income as a way to target how much you should pay, and you'll end up saving yourself some money here. So I think that, you know, that in terms of the, I think people oftentimes just discount income-driven repayment and how helpful it can be, even as a gauge, right? Just the concepts of it, you know, using it percentage of your income to help you determine how much you should pay and see what that ends up costing you in the long run. Any questions on the lower student debt scenario?
We just have a question about the classification of student loans, federal versus private. Does that impact your credit in the same way?
Well, so if you have both, I'm assuming, so if you have both federal student loans and private student loans, what's going to impact your credit? It depends. You know, it's not really going to impact your credit until you go to make another purchase, right? So paying, you know, using income-driven repayment does not reflect negatively on your credit, right? So that's the first thing to realize. If you have both federal student loans and private student loans, you're going to have one that, if you're using income-driven repayment, is going to show a pretty low percentage of your income. And then you're going to have a private loan that, depending on how much the balance is and what the interest rate is and the term of that loan, is going to show a minimum payment due that has nothing to do with your income, right? So it can impact how much you're eligible to borrow if you're going to make a home purchase or a practice purchase or a car purchase, right? They're going to look at your overall debt to income ratio. And because you don't really have a way to adjust a private loan based on your income, that may look not great when you go to make a major purchase if that private loan amount is a pretty high contributor to your monthly cash flow, right? So, or the payment that's due, right? So it really depends. So, you know, first thing to take away there, income-driven repayment does not reflect negatively, as long as you're making the minimum payment due, right? It does not reflect negatively on your credit report. If anything, it may help, right? So it helped my wife and I. We both use income-driven repayment, helped us buy a home here in Denver using revised pay-as-you-earn. It's 10% of our discretionary income, right? So we look like a pretty good borrowing candidate, even though we have in excess of $400,000 of student debt. Our payment showed us in good standing and was helping to build a credit history, and it also was a manageable percentage of our income, right? So it helped us to get our home. So in addition to helping us save for the down payment for that home, right? So it's not going to reflect negatively, but if you have too much in private loans, it can, because it can occupy too much of your monthly cash flow.
Right. Yeah, that makes perfect sense. Another question, when money goes into retirement, is that part of taxable income? Or if we have a higher proportion going into retirement, would that decrease your IDR payment?
Yeah, that's a great question. So, you're putting the pieces together. That's exactly right. Right. So some retirement funds allow you to contribute pre-tax earnings, right? So your 401ks, traditional IRAs, 403bs, depending on the type of retirement fund that you have access to or that you're contributing to, some of that is pre-tax income, right? And your minimum monthly student loan payment is based on your taxable income. So now you have a double incentive to contribute to your retirement. If the more you contribute to your retirement, the more you may reduce your taxable income, the more you're going to reduce your minimum monthly payment, the less you'll pay towards your student loans, right? So and you'll have more in retirement, right? Because you're maxing out your retirement savings. So yeah, absolutely. Start putting the pieces together. If you can, if you're worried about not being able to save for retirement, actually income-driven repayment can help you with that, right? And you'll get a double benefit because it incentivizes you to max out, particularly those pre-tax contributions, right? So it gets a little dicier in terms of, should I contribute to a Roth versus a pre-tax? That's really more of a preference things and what you think your tax rate is going to be in the future. But I really like the interplay between the 401ks and traditional IRAs, where it really incentivizes you to max out those pre-tax contributions so you can minimize your student loan repayment amount and also have more in retirement.
Yep, that makes perfect sense. And I think the way to think about this is looking at ins and outs. Look at the amount of money that's coming in every month and look at the amount of money that's going out. And if you can minimize the amount that's going out, obviously you're going to be in a much better situation. And when it comes to things like loans, that's what the banks care about is can you meet the bills that you currently have? So if you have flexibility in the amount of money you pay every month, that's only going to work to your advantage.
And one last thing I'll add there is that, your retirement savings, you have decades of hopefully continued compound growth that you can earn, right? Your student loans are simple interest, right? So that your student loan interest is not compounding, right? So, for the folks who think that, well, I've got a 6% student loan interest rate, it doesn't make sense for me to contribute to retirement because I don't think I can earn 6% on my retirement savings. That's not the same, right? You're looking at compounding your retirement savings growth over decades, which is an amazingly powerful tool. Whereas your student loans are accumulating simple interest. Even if you're income-driven repayment and not covering the interest that accrues, that interest does not compound, right? It stays in that unpaid interest. So if we go back to that first person who I uploaded their NSLDS file and they had over $100,000 of unpaid interest, that unpaid interest does not accrue additional interest, right? So that's one of the other benefits of income-driven repayment is that unpaid interest just gets pushed into forgiveness and you end up paying that taxable fraction on that in addition to the principal, right? But it does not compound. So you can't compare, retirement savings to paying off your student debt.
Yeah. So if you have extra money every month, you think very carefully where to put that to use it to its best advantage, and paying it extra off on your loan may not be the smartest way to use that money.
Absolutely. Yeah. All right. So the elephant in the room, right? The married student debt scenario, right? These are the most complicated, and we're just going to kind of scratch the surface here. And in many cases, I don't even have a really good simulation tool for you to use, but we can use it to illustrate concepts. I mean, we are working on a version of the simulator that will help you do some dual income-driven repayment simulations. We're getting closer to that, but it's extremely complicated. And we want to make sure that math is reasonable before we roll that out to you all. So we're going to start to scratch the surface of some of the things that I think about when I get questions from married folks, particularly if they both have student debt, if only one of them has student debt, and then if they live in one of the community property states. So first, before we dive into that, how you file your taxes is going to play a part in what your monthly student loan payment is, right? So in the what I call the double debt scenario, right? But this can equally apply to those folks who, didn't go to vet school, but some other kind of graduate school. If you both have student debt, and is both eligible federal student debt, so direct loans or FFEL loans, they will take that into account if you're filing your taxes jointly, right? So there's going to be a proportion calculation done where they're going to say, well, how much of the household student debt balance do you hold, and how much does your spouse hold? And then they're going to apply that proportion to the monthly payment that's calculated based on your joint taxable income. So if you file jointly, your spouse's income will be considered. If your spouse has eligible federal student debt, that will also be considered, right? So that's the first take home. If you, I guess the challenge with this is that generally there are incentives in the tax code to have you file your taxes jointly. So to get married, file your taxes jointly, have kids, there's incentives in the tax code for that. Unfortunately, the way that the income-driven repayment plans are structured, they actually disincentivize those things, right? So you have some competing incentives now. So it's actually sometimes more beneficial to either not get married or to file your taxes separately, depending on your student loan situation, right? So here we're going to cover this really quick here, but basically pay-as-you-earn and income-based repayment offer you the most flexibility because they allow you to separate your income from your spouse, right? And you do that by filing your taxes separately, right? Revised pay-as-you-earn, they don't care how you file your taxes. So revised pay-as-you-earn, as beneficial as that plan can be, if you get married, even if you file your taxes separately, they want to see your spouse's income and they're going to consider it in the calculation. This asterisk here is there's always exceptions, right? So if you're married and you're separated or you're going through a divorce, they're not going to make you go get your, maybe soon to be ex-spouse's income and provide that for your student loan repayment purpose, but that's the only exception to that, right? So if you are married and you're not otherwise separated or going through a divorce, they're going to want to see your spouse's income. They will allow you to consider your spouse in your family size, even if you do file your taxes separately. So let's say you're married and you're using pay-as-you-earn and you want to file your taxes separately, you can still consider your spouse in that family size, and you higher your family size, the larger that allowance in that discretionary income calculation, so the lower your monthly payment. And you're going to want to compare cost savings between the tax filing options, right? So this is it's just an ugly math exercise, right? So you're gonna run simulations using the student loan repayment simulator, indicating whether you're filing your taxes jointly or separately. You're going to see what the cost difference is between those two options, but then you're going to also need either the help of a tax accountant or some other tax preparation software to figure out what your tax costs are going to be filing separately versus filing jointly, right? There'll be very distinct differences in what your adjusted gross incomes will be filing jointly versus filing separately. So what the difference is between there, whether or not that's going to cost you more than you're going to save in student loan repayment costs, that's what's going to ultimately determine which way you should go. So if we take a peek at this double vet, double debt scenario, your goal is to minimize your monthly student loan payments and maximize your cash flow, right? I mean, you want to have the most money in your control to do what you see fit with it, right? So you can decrease your monthly payment, but decreasing your monthly student loan payment is going to increase the amount that you need to save for forgiveness, right? So when you pull on these strings, there's always going to be a side effect associated with it. So you may be able to file your taxes separately to decrease your monthly student loan payment, but that's going to increase the amount that you need to save for the tax that's due at the end, right? So you have to factor that in as well. Generally, filing your taxes separately is going to increase the amount that you pay in income taxes. So we have to figure out which one wins. So it's a bit of a balancing act. The magnitude of your respective debt is going to play into this equation. So we used to, when we first started doing this, we used to think that if you both had student debt, that it just made sense to file your taxes jointly and have the proportion calculation figured out. But the more we run specific scenarios, the magnitude of the respective debt really plays a role in there, right? So if we have a veterinary size student debt and we have a spouse who has maybe an undergraduate size student debt, those are cases where sometimes it makes sense to file your taxes separately, right? And we're learning that through the VIN Foundation Student Loan Repayment Simulator, running those respective simulations, and also seeing the savings that you might be able to realize in those monthly student loan payments. You also have to take into account your respective incomes, right? So who's the primary breadwinner in the household? Are they the person who holds the highest student debt balance? Are they the person who might be going on unpaid maternity leave, right? So those types of things may determine whether or not you file your taxes separately or jointly, depending on how much flexibility you want to have in order to decrease that monthly student loan payment. And some of the more complex ones that I've seen or worked with are folks who are either both working towards public service loan forgiveness, or one of them is working towards public service loan forgiveness and the other one is not, but they both have a veterinary sized student debt load, right? And public service loan forgiveness, we're not talking a lot about that tonight, but public service loan forgiveness, I mean, the goal of that plan is to pay as little as possible and have as much forgiven tax-free as possible. If you're married and you both have student debt, then you want to make sure that that person working towards public service loan forgiveness is going to maximize that loan forgiveness, right? So in those cases, it's going to make sense to keep those payments as low as possible, particularly on that person who's working towards public service loan forgiveness, so they can maximize that forgiven amount. And that's usually going to favor filing jointly in the double debt scenarios. But again, it really depends on the specifics of the circumstance. Then also, when did you each start repayment, right? So you may not have forgiveness happen in the same year for you. That may be a good thing, right? So it gives you some extra years to plan for a second forgiveness event. Or, maybe like in the case with my wife and I, we're probably going to hit forgiveness in the same tax year, which means we're going to have to cover a bigger amount, right? So that's not one that we've really considered a whole lot yet, because we're still quite a ways before we see some people experience the taxable version of forgiveness. But again, start planning, right? Even if you're not quite sure when you're going to hit forgiveness, start planning, right? It's in the future, right? So take advantage of the time you have now to get towards there. And then periodically, you're going to want to check in with your loan servicer to see where you are in terms of how many qualifying payments have you made. The good news is, I've requested that from my loan servicer. I've been encouraging other veterinarians to check in with their loan servicers, and they are able to provide that information, which is a great sign. Your records may not match theirs, which means you've got some time to maybe correct that and help them work through that process. But it is a huge step forward that they can even produce a document that says how many qualifying monthly payments that you've made, because a couple of years ago, they couldn't even do that. So we are moving in the right direction when it comes to knowing when forgiveness is going to happen. It's going to be quite a ways down the road for everybody. Whether you've just started repayment or you've been in repayment for 5 years, you still got a little ways to go. So start planning. And if you're not quite sure, right, and you can't find a tool that's going to give you a really good estimate, then use your total student loan balance as a gauge, right? So that's kind of what I've been doing with my wife and I as we work towards that new version of the simulator, where we can help you guys simulate this more precisely. I know that our student loan balance right now is not increasing a whole lot. So I'm using the total balance that we have as a rough estimate of how much we're going to have forgiven when we do reach forgiveness in about 18 years or so, right? So I can use that as a gauge, and in the meantime, between now and the next 18 years, I can definitely tell you we'll have something that you can nail that tax down a little bit closer, but you can use that as a pretty good ballpark to get started. So I'm going to use this simulate. Actually, I want to, yes, let's use this as a gauge. So I pre-filled the simulation here, and that link is actually one that you can generate. You can save these simulations that you generate. So you can click the Save Share button here and copy these links if you want to run multiple ones, or you want to share a version of a simulation that you've run, or you just want to remember what you put in here. But what I want to start with is kind of more of a theoretical exercise here. So let's do a recent graduate, borrows $200,000, has $25,000 of interest. and I'm going to have them starting with a $90,000 starting salary with a 3% income projection, and that'll do that math for you there. I'm going to say, yes, I am married. Spouse's annual salary, about the same. I'm going to assume that maybe these were classmates that are getting married or got married right before they graduated, has a similar amount of student debt, and I'm going to run this first simulation with them filing jointly. I'm going to assume they have a couple of kids already, right? And I'm going to leave these defaults for the advanced simulator settings as they are. And what this repayment summary is going to show you is the scenario for the primary borrower, right? So the primary borrower in the simulation is the information that you enter in the top here, right? So this is going to be the primary borrower, and all of the data in the output is going to reflect that borrower's repayment cost. So I can see that if we factor in both of their incomes, which are the same, and their student debt balances that are roughly the same, right? I can see that this person is going to have a payment of about $589. Right, so their total monthly student loan payment under income-driven repayment would be twice that, right? But because the primary borrower has half of the household student debt, half of the payment goes towards their student loans, right? And I can see that they hit forgiveness under this particular scenario. So I'm looking at what is this ballpark monthly savings going to be for me? So $263 a month in this estimation. And now I'm going to go up and switch this to separately. How will I be filing my taxes, right? So now we're going to disconnect the spouse's salary, the spouse's student debt. And again, I'm going to focus on pay as you earn here just for simplification. I can see that monthly payment goes down a little bit, right? Because I have a family size of 2 now, and I'm just considering a single income, right? So I'm saving a little bit, $160 or so in a monthly student loan payment, right? But now my forgiven amount has gone up, right? So before it was about $266 a month, I think. So we got to add another $60 a month to that calculation, right? So I'm eating away at some of my savings here. I still net out maybe about $100 a month ahead by filing my taxes separately from my spouse in this situation, but $100 a month in student loan repayment savings. Now I need to compare that against how much is it going to cost me in taxes to file my taxes separately, right? So if it's going to cost you more than $1,200 that year, right, $100 a month, $1,200 that year, if it's going to cost you more than $1,200 a month to file your taxes separately, then you're not gaining any ground, right? It would be better to file your taxes jointly and pay the additional towards your student loans. However, if it's not going to cost you that much more to file your taxes separately, maybe it's going to be less than $1,000 for that year, then that would favor filing your taxes separately, right? So that's where you can use the simulator to help you work through that exercise, and then you want to use that accountant or your tax preparation software to help you figure out how much it's going to cost you to file your taxes separately for that year. Go back. I lost my sorry. There it is. Okay, so what if you have, or actually let me go back there really quick and just pause and see if Carl, if you have any questions on the double vet, double debt scenario. Carl, you hear me? Oh, I'm not hearing. I'm getting a little feedback on that. All right, we'll go into the, Carl, I'm having a hard time hearing you. I'm gonna roll into the one vet with a one vet debt balance and a spouse with no debt. So in these cases, I think there's a few more generalities that we can make. it often makes the most financial sense to file separately. You may pay more in income taxes, but you're likely to save much more in student loan costs, right? The key here is that you have an option to pay less towards your student loans if you want to, right? This is purely up to you. I know there's a lot of folks out there that want to take the approach that they will live off of one spouse's income, and they're going to put all of the other spouse's income towards the student debt balance to get rid of that balance as fast as possible. But you don't have to do that, right? That's your choice. You may end up paying more actually and having less cash flow flexibility by doing that. But you have the option here to file your taxes in a different way and potentially pay less towards your student loans. Right, and it also gives you that flexibility to work on other areas of your financial plan or goals. Right, so the exceptions to this are as if your spouse has low or no income. Right, so there's a lot of scenarios out there where we have, maybe the veterinarian's the primary breadwinner and the spouse is staying home with the kids and doesn't have a taxable income. Well, in that case, it doesn't make a lot of sense for you to file separately. Right, so this is only to help your monthly student loan payment decrease because you don't want your spouse's income factored into the equation, right? So we're going to want to, if your spouse doesn't have income or actually has a lower income, and that's pretty subjective, but you're going to have to run that calculation to see for yourself. But generally speaking, if your spouse has lower income, sometimes it doesn't make sense to file separately either. And if it's low enough, it won't contribute all that much to your minimum monthly student loan payment. That's particularly true with increases in family size. So once you have more kids, if your spouse has low income and you have a higher family size, it's going to favor filing jointly versus separately, even with income-driven repayment. And then also, if your income taxes exceed that student loan repayment savings, right? So like we covered in the last example, if you find out that filing separately is going to cost you more in income taxes than you're going to save in your monthly student loan payment or your yearly student loan repayments, then it doesn't make sense to file separately, right? And this is strictly for student loan repayment purposes, right? So those are the ones that I deal with most frequently. There may be some other reasons that you would consider filing your taxes separately, but we're considering here particularly for student debt purposes. And I have a example that I'm going to use here. I'm going to go back to my Student Debt Center. Come back up here. I'm going to upload a different one.
I have one of your favorite questions, Tony, if you want.
Sure. While we're waiting, while the file is uploading.
If you have two vets, but only one with debt, is it beneficial to not get married until you pay off the debt?
Oh, man. That's a good one. It really depends on, it depends on, is this going to be a mathematical decision or is this going to be an emotional decision, right? So the math is going to have one answer and the emotion is probably going to have a different answer, right? So it's going to put you in a position of discussing with that other person how much weight does the math carry versus how much weight does the emotion carry, right? So I generally tell people never to make a marriage decision based on their student loans because there's usually always an option for us to work around accommodating that, right? However, if you are a strictly mathematical person, then oftentimes it will come out that, yeah, you're better off not getting married, right? But, those are the few, right? The folks of us, the few of us that can actually put the numbers ahead of anything and everything else. That's a tough one. So, Paul, I know that you have some feelings on that, and I'll let you take off on those.
I'll keep them to myself.
Yeah, so I would encourage you to run simulations. Make sure you're running them with that person, right? And you'll see if that number is rather large, then it may change your plan. But if it's not, then again, I really wouldn't purely base my decision to get married on my student loans alone, right? So, but if the numbers are big enough, it's oftentimes hard to ignore. All right, so we have a recent graduate here uploaded our NSLDS file, and I can see in this one, so here's an example of somebody who is not using the auto pay deduction, right? So this is a consolidated interest rate rounded up to the nearest 1/8 of 1%. So this person could get a 0.25% interest rate reduction by enrolling in auto pay. I can see that they're using IBR. Their monthly payment is $1,500 a month, right? Which is more than the interest. So they are on a trajectory to pay this balance to zero, even using income-driven repayment. Next step, I'm going to look at the income. Sorry about that. I'm going to look at the income-driven repayment eligibility, and I can see that this person qualifies for the most beneficial income-driven repayment options that are out there. And now I'm going to send this over to the simulator. And I'm particularly going to be looking at pay-as-you-earn here. So I know that this person is, and I think I have, I'm going to use this, I have this simulation already loaded up. Sorry. Machine there. So I'm going to load up this simulation, and this person is married, and what we wanted to look at was whether or not it made sense to continue on in income-driven repayment based on the fact that filing jointly had them paying $1,500 a month, and they were really looking for a little bit of flexibility in their income because they wanted to buy a home, right? So this is the income of the veterinarian. Here's the income of the spouse, right? So we can select married separately, right? They do have 2 kids, right? And we've already run this simulation, and I can see that if they were to file their taxes separately and switch to pay-as-you-earn, which they qualify for, their payment would be $666, right? Which their monthly payment now under IBR was over $1,500, right? So they could free up $900 a month just by switching their repayment plan and filing their taxes separately, right? So in this particular case, that's a pretty strong pull to filing your taxes separately and moving over to pay-as-you-earn. And because they've been making payments above the interest, they don't have any unpaid interest to consider being added to the principal if they switch. We can see if they continued on in IBR that they'd pay their balance to zero in 16 more years. Right? But under pay-as-you-earn, that's going to change, right? So they're going to have a balance forgiven, but in this case, it ends up being less expensive, right? So the forgiveness for them is going to pull down the total repayment costs while giving them that cash flow flexibility, right? But we do have to factor in this forgiveness plan, right? So we have to add in a couple $100 a month to what we're paying to cover that tax that's due, right? So now we're up to about $866 a month, right? Which is still $700 a month in savings over what they're paying now in IBR, right? So, and it pulls down this repayment cost, as we covered a little bit earlier. If we're planning for forgiveness and we're putting that in something that yields interest, we're actually going to decrease those costs. So we can see that this one really favors filing our taxes separately, lowering the monthly student loan payment because it helps us accomplish that goal of giving us more cash flow flexibility, and it's going to decrease our student loan repayment costs. We can go back up here, and actually we don't even need to. I know that this person, they did go through the exercise of how much it's going to cost them to file their taxes separately, and it was going to be about $900, right? So they're going to save almost more in 1 month in their switching their student loan repayment plan than they are going to pay in taxes for that whole year by filing their taxes separately. So in this case, highly favors filing your taxes separately, going for the lower minimum monthly payment, planning for the forgiveness, right? We can do that and still give ourselves $700 a month to help us meet that home purchase goal that they're trying to reach sooner rather than later. Right, so that's where analyzing each year. We're in tax filing season now. You're going to have a pretty good idea of what your adjusted gross income is. Try to find out what it might be if you're married to file separately, and then compare that against what that would do to your student loans. It can often be more than worth your time to do that exercise. Any questions on this one before we go into community property states? Carl, I don't know if your mic's back.
Can you hear me?
I can, yeah.
Okay. No, I think we're good to continue. There's a couple of general questions, but I think we'll look at those.
Okay.
Once you're finished.
All right, great. So we're going to just to cover community property states. So if you're one of the lucky folks that lives in one of these 9 states, right? So Arizona, California, Idaho, Louisiana, mostly west-south states, and then we've got the kind of oddball Wisconsin in the middle there. And Alaska is kind of an optional community property state. This can complicate things a little bit, right? So it's not impossible, it's just different. So these community property states, in order for you to separate your income from your spouse, they're going to basically consider your income as a pool, and then they're going to split it 50-50, right? So half of your income, the household income, is going to be assigned to your tax return, and the other half will be assigned to your spouse, right? So in order to be eligible to separate your income from your spouse, you're going to have to file your taxes separately, which is going to have this weird 50-50 phenomenon associated with it. And then you're going to have to decide, is the adjusted gross income from that 50-50 tax return a reasonable representation of my income? And can I use that to document my income for student loan repayment purposes? So this is what it sets up, this scenario where, let's say that your income is $100,000 a year and your spouse's is $50,000 a year, and you live in a community property state. If you file your taxes separately, they're going to pool that together, so $150,000, and then they're going to divide it in half. So you're going to get 75 and your spouse is going to get 75, just as a real simple example. But your income is 100,000. Right? So you're going to be in this awkward position where you're going to have to decide, should I use the tax return that says 75,000, which is going to give me a low monthly payment, which is kind of what I want for income-driven repayment, but you're going to be faced with this question that says, is your income significantly different than what your tax return says? So that $25,000 difference, it's going to be on you to determine whether or not you think that's significantly different. Right? So the flip side can also happen, right? So if you're the one with the $50,000 income and your spouse is with the 100, well, now you're going to have a tax return that says 75,000. You're probably not going to want to use that, but you have to file your taxes separately in this way so you can be eligible to use the $50,000 income as dictated maybe by your pay stubs. Right? So to kind of see how this works, let's look at what the income-driven repayment application actually shows, right? So this is section 4. This is not the whole application, but this is section 4. What is your marital status? So you're going to say married, right? Continue to item 8. Does your spouse have federal student loans? Let's say no in this case. Skip to 10. When you filed your last federal income tax return, did you file jointly with your spouse, right? So if you're filing separately, you can say no, right? Then we move over to section 4D, which is 17. Has your income significantly changed since you filed your last federal income tax return? Right? So this is where it kind of hits the brakes. You have this, and then you've got this scary language on here that says, remember, any person who knowingly makes a false statement can be subject to penalties, fines, imprisonment. This is all very scary stuff, and it's really related to are you making a reasonable representation that what your tax return says is actually close to your taxable income, right? And that's going to be up to you to decide, right? Significantly is an awful, awful word, right? Somebody's significant and somebody else is non-significant. So in that, I don't have an easy answer for you, right? In that example where, your income is 100 and your tax return so shows 75, is $25,000 significantly different? Again, you can ask 5 people that question and you'll probably get 4 different answers. So it's going to be up to you. But the good news is you can say yes, right? And then you're going to have to provide your pay stub, right? So now you'll send in your pay stub or some other documentation that shows your taxable income that'll be closer to maybe that $100,000 in that example. That will be a reasonable representation of your income. You don't have to worry about any of this other stuff. That said, I have yet to have heard anybody being audited for any of this. I'm not even sure what the process would look like. And, it's really kind of on the honor system for you to state that what you've sent in is a reasonable representation of your income that complies with the statements all on this form, right? So, but in order for you to have the option to provide just your pay stub, you're going to have to file your taxes separately, even in one of these community property states. I don't have yet, so if we go back into the simulator, I don't yet have a way for you to indicate a community property state or to separate your incomes 50-50 like that yet. But what you can do is assign half of the income to the borrower and half of the income to the spouse, and that will mimic a community property scenario. So you kind of have to fudge the simulator in order to make it work for community property states right now, but you can do that by splitting your household income in half and assigning half to the borrower and half to the spouse to get an estimate of that. That is all of the content that I have. So if you have any questions, I thank you for sticking with it. And if you have any additional questions on stuff that we've covered tonight, feel free to fire those off now.
Okay. We had one question. Someone's about to graduate in May, and they're asking if they should let their 6-month deferment period play out before starting to make payments, or should they start enroll in IDR payment immediately?
Yeah, so we're going to cover student and very close to graduation folks this Sunday in a VIN rounds, and all veterinary students have access to those for free through VIN. But just to make it explicit here, don't use that grace period, right? You want to get into repayment as soon as your loans allow, and that's going to require you to consolidate your student loans, waive the rest of your grace period, and enter income-driven repayment. The grace period doesn't really help that much. You just accrue a bunch of interest. It just postpones the clock ticking on forgiveness. Also, if you do it soon enough, you can secure a $0 payment for the first 12 months if you can get that application submitted before you start your job or your internship. But we're going to go into more details on that this Sunday in a VIN student rounds.
Okay. How often should you be checking with your student loan servicer about on-time qualifying payments? Yearly?
If you're using auto pay, you know that you're at least making the minimum payment that's due, right? So I would request, if you've never asked them for the number of qualifying payments you've made, now is a great time, right? I don't know that you need to do that every year, but if you want to, you can, right? You got to apply, you got to send in your income documentation every year too. You might as well ask them, right? And then hopefully the more people that are asking them, the better they're going to get at producing that documentation, and hopefully the more accurate it's going to be. But unlike public service loan forgiveness, where it's been a little bit iffy in terms of what they consider a qualifying payment or not, for the taxable version of income-driven repayment, I don't know that you need to do it every year, but it certainly wouldn't hurt. Right. So I do it mostly out of curiosity to see what they can and cannot produce. But if you don't have a good record of that yet, or you think that there's some confusion, right? So some of the things that I see all of the time are people end up, getting put into deferment or forbearance, even whether they knew it or not, right? So if you go on unpaid maternity leave and they put you in deferment or forbearance and they leave that in place for 6 months, 9 months, 12 months, that doesn't count towards forgiveness, right? So if you had any periods like that where you're not sure, or if they took an inordinate amount of an excess amount of time processing your paperwork to get that monthly payment processed, you might want to check in and see if they counted some of that time towards forgiveness. So it's up to you, really, in terms of if you've never done it before, now is a great time. If you think it's been a little bit up and down, then maybe you want to do it every year. But I don't know that you need to do it every year for income-driven repayment.
Okay, we have some students that are currently in vet school. They're looking to make some extra cash over the summer. What should they do with that money? Pay off some interest that has accumulated, or just not take out additional loans?
If you've got some extra money, I would reduce the principal, reduce the amount that you're going to take in the future. If you have some extra money now and you're still within a 120-day window of borrowing those student loans, then you can return those amounts and the interest and the fees will go along with it. But paying your interest while you're in school does not help you. So you're going to end up with a lower principal balance, a lower starting repayment balance if you reduce the amount that you borrow rather than paying the interest. But that's another thing that we're going to cover in more detail in the student rounds this Sunday.
Yeah, a follow-up question to that would be, someone's asking me if they should borrow the maximum amount even if they don't need it, assuming they're going to qualify for forgiveness.
Yeah, so that's coming up more and more frequently. So the more schools I visit, there's always I call them the schemers. I mean, there's always one person in the classroom who's like, well, if I'm just going to have it forgiven anyway, why don't I just borrow it all? And I've even heard some worse ones yet, where there's some folks that are encouraging people to take out the maximum and put that towards the forgiven amount. And I just think that's really dangerous, right? I mean, that presumes a lot of things, right? That everything's going to work out the way that you expect. The more you borrow, the more you can have forgiven, right? Which is the more pressure you're putting on yourself to make sure that you have enough to cover that tax that's due at the end. I mean, the less that you borrow, the less you have to manage, the less is going to be forgiven, the easier this is to manage, right? I mean, and for the most part, we're talking about folks who are in veterinary school, went to veterinary school because they love animals, not because they love finance, right? So for you to take out a whole bunch of money and do a lot of speculating with it in the hopes that you're going to somehow beat some average return with your student loans seems like a real nefarious plot to me. So I would steer clear of that, minimize the amount that you borrowed. You want to have a little bit of a buffer, right? But so you're not living penny to penny, but you don't need to take out the max in hopes that you're going to do something miraculous with that, because chances are that's not going to work out. And you're just going to be left with trying to cover more forgiveness than you otherwise would have had to.
Right. What about taking out life insurance just to cover just the student loan debt balance?
Yeah, so I think life insurance is great, but not to cover your student loan balance, right? So if the worst should happen to you, your federal student loans go with you, right? Nobody else is responsible for paying those. Your spouse isn't on the hook for those. So if you come across a life insurance agent that's trying to get you to boost the amount of life insurance you need because of your student debt balance, look for another life insurance agent, right? The rules don't require any funds to cover a canceled student debt balance because of your untimely demise, right? So your life insurance should be for other things, your family, helping to provide for them if your income all of a sudden disappears, right? Those are the things that your life insurance should cover. They don't need to cover your student loans.
Okay, just a couple more questions and we'll wrap up. Okay, so do you recommend paying off the interest before it capitalizes if you have low debt?
It depends on where that money's coming from, right? So if it probably doesn't make a lot of sense, right? It's still better to, even if you have low debt, it's still better to get into repayment sooner and then potentially even get that $0 payment for the first 12 months. So you can get moved, get started, start practicing veterinary medicine, start learning what your income is going to be without having to wonder what your paycheck's going to show, how much you're going to need to cover your expenses, and how much you should be putting toward your student debt, right? It's not a race. Paying down your student debt is not a race. It's not going to benefit you to treat it like it's a race. So get yourself started, understand your budget. It would be even helpful to have that $0 payment for the first 12 months, and you'll pay your balance to zero in a reasonable amount of time, right? But you'll also be able to start building an emergency fund, start your retirement savings, start figuring out what it means to earn money as a veterinarian, right? All of these other things that way exceed the importance of paying down a couple $100 more of interest on your student loan interest before you're even earning an income, right? So don't worry too much about that when you're in that scenario.
And I think to some people that seems a bit counterintuitive, especially, you know, if they talk to their parents. You know, often there's a drive to pay down debt as quickly as possible, and I think that hopefully people are starting to realize that that's not always a good strategy, and certainly when it comes to student debt, it could be a costly strategy to do that. You know, people do tend to forget about retirement and having savings, and then they get into a situation where they're close to retirement, have nothing saved, or they have illness or something, they have no emergency fund. So it's easy to say, well, I'll save for that later, but it makes much more sense to put that money into those things from the start. It gives you a better safety net for the future.
Absolutely. I would be much more inclined to get an emergency fund started rather than trying to pay back my interest during my grace period, right? I mean, again, you're probably not, maybe you haven't even started your job yet. You don't even have an income. I mean, these are things that, you know, again, there's no reason to put that kind of pressure on yourself, right? If your debt to income ratio is 1 or close to it, you're gonna pay your student debt balance off in a reasonable amount of time, 10 years or less maybe, right? So put that a little bit lower on the priority list and start those other things, or start thinking about those other things that are going to have much bigger long-term impacts than paying down that interest before it capitalizes.
Okay, I think there are some other questions about specific situations, and I think what I'd recommend for those people is go on the student debt simulator, play around with the figures, you know, and you could probably answer your own questions. If not, obviously contact us and we can see what we can do to help. But hopefully you have enough information now to go and start punching in some numbers, looking at scenarios and figuring out for yourself which is the best you know, option for you. It's an incredibly powerful tool, and it's fairly easy to use. And I think for a lot of people, it should be fairly apparent. If it isn't, you know, we're here to help.
Exactly. Yeah. I mean, you start plugging in the numbers, that you start relating all of these concepts to your specific circumstances, and then the next questions come up, right? They just pop up, right? And then when you start seeing numbers applied to what seems like a really confusing mess, then you know what questions to ask next, right? And then you just keep peeling back the onion until you get all of your questions answered, and suddenly you have a plan, right? And that's really what we're trying to get you all to get started is a plan, and then revisit it and adjust it if necessary. And if not, just have some more confidence that what you're doing is going to be the most beneficial plan for you.
Absolutely. Well, I think we'll wrap. Thanks again to Jordan, Tony, all the VIN people for making this possible. Thank you everybody for attending. If there are questions that are not answered, please feel free to post them on the Facebook page. Or contact us at the VIN Foundation. We'll be happy to help in any way we can. And big thanks to Paul Pyon for stepping in when my microphone was misbehaving. And good night, everybody. Hopefully we'll do some more webinars in the future. Maybe we'll do something on you know, financial planning, or some more based on the questions that people ask. But thanks everyone for attending.
Absolutely. Thank you. Thank you, Carl. Thanks, Jordan.
Everybody, and just so you guys know, you can keep your email, an eye out for an email in the next few days. We'll send a link to the recording and a blog post with any follow-up questions, etc. Thanks, everyone.
Yep, great. Thank you. Have a good night.
Good night.